Hey, what's up, my friends? So welcome to today's training called the Ultimate Guide to Price Action Trading for Beginners. And even if you're an advanced trader, this training is for you because we will also dive into advanced price action trading concepts as you'll learn shortly. So in today's video, you'll discover number one, the 3 common price action trading mistakes that almost all new traders make, right? And how you can avoid it. There we'll talk about the simple price action strategy that you can use to profit in bull and bear markets, even if you have no trading experience. There we'll talk about advanced price action trading strategies and techniques to minimize your losses and maximize your profits. Along the way, I'll share with you a ton of charts and examples so you can quickly understand the concepts and strategies. Sounds good? Then let's get started. Now, let me ask you, how many times have you heard of guru telling you, man, you must aim for a minimum of a 1-to-2 risk-reward ratio. This way your winners is larger than your losers. Right? Have you heard that, So here's the thing, right? If you always aim for a minimum of a 1-to-2 risk-reward ratio, that's a mistake. Why is that? It's because the market doesn't care about your price target. It doesn't care about your risk-reward ratio. It doesn't care what you had for breakfast. The market pretty much goes where it wants to go based on the buying and selling pressure in the market, or in other words, based on supply and demand in the market. And by having a fixed risk to reward ratio, right, minimum of 1-to-2 risk reward ratio every time you put on the trade, you are pretty much disrespecting the market. And when you disrespect the market, what happens? Well, it's going to be painful for your own trading. So let me explain, right, what I mean by disrespecting the market. So you have a look at this chart, and most traders will look at this chart and look at this. Oh man, Rainer, this is a range, right? In a range, you should buy low and sell high. Well, guess what? You buy low, right? So let's say this green line is your entry price. Then you must have a stop loss, right? To protect your downside so you don't blow up your account. So your stop loss is over here. And then you also know that, most gurus tell you must aim for a minimum of a 1-to-2 risk reward ratio. And how do you do that? So if your entry price to your stop loss, let's say from here to here is, let's say 300 pips, okay? Then your entry to your target profit must be 2 times of that, so that would be 600 pips. So let's say from your entry to your target, it should be 600 pips, right? So this is where your target is. So if I just bring out that line, it should be somewhere about here. Sorry, missed it by a little bit, right? So your target is here. So you can see that your target, right, your potential target, or rather your target profit from your entry price is 600 pips. Entry to stop loss is 300 pips. So this is what traders mean, right, by having a minimum of a 1-to-2 risk reward ratio. So when you're risking 300 pips to make 600, you can see that you're in essence kind of like risking $1 to make $2. So this is what we mean by having a 1-to-2 risk reward ratio. And why is this a problem? Why are you disrespecting the market, right, when I say you have a fixed 1-to-2 risk reward ratio? Because when you look at this chart, what's the problem? Pay close attention, right? Your target is over here. As you can see, your target is over here. But if you look closely at the price structure of this market, there is an area of resistance over here. So as you know, right, if you're not familiar, an area of resistance is where buying pressure could possibly come in and push the price down lower. So in other words, the price could go up higher, come into resistance, and then head down lower. So by setting your target over here above resistance, you're making the market work harder for you. And as you've known by now, the market doesn't care what you want. It pretty much go where it wants to go based on buying and selling pressure in the market. If you make the market work hard for you, guess what? It's gonna hurt you. So this is why it's, whenever you aim for a 1-to-2 or 1-to-3 risk reward ratio and you don't reach your target, right? You see the market goes in your favor and then reverse back and hit your stop loss. This is the reason why. It's because you're not respecting the market. You're not respecting the price structure that's in front of you. So what's the solution? If you ask me, a better approach is that don't have a fixed risk to reward ratio in your mind, right? Trade what you see, right? Not what you want from the market. So if you ask me, a better approach is to actually have a more conservative target. In this case, your target is right just before this area of resistance. This is where your target is. So you can see over here, this is the same area of resistance. And this time around, shift down the target to slightly lower just before resistance. This way, right, you have a higher chance of your trade, right, exiting for a profit. So yeah, no doubt your profit target is smaller, right? But the odds of you exiting with a trade for a profit is higher. So let me ask you, would you rather have, a smaller profit target, but with the good odds of the trade, earning you a profit? Or would you rather have a much larger profit that has a very low odds of the market actually, giving you that profit? Right, so think about that. Mistake number 2 is this, right? You misunderstand candlestick patterns. So what's the most popular, right, candlestick patterns of all time? In my opinion, I believe it's this pattern over here, the hammer, right? So most traders will look at this, right, green candle, right, and it's actually called a hammer. And let me kind of explain to you what a hammer means and how traders, right, kind of like, use this in the wrong context. So a hammer, pretty much this is the opening price. This is the closing price. This black line at the highs over here is the highest price point of the time period. So for example, if you see this hammer on the daily time frame, This one over here simply tells you that this is the highs of the day, the highest price point, right, over the past 1 day. And this is the low of the day. This is the lowest price point of the day. Okay, so the story behind this is pretty simple, right? When the market opened, right, the sellers took control and pushed the price down lower, right? Eventually, you know, the buyers stayed, oh, no, that's as far as you're gonna go, right? And the buyers starts coming in, right, and push the price up higher, closing near the highs of the day over here. So it's kind of like, you know, if you watch Avengers Endgame, right, you know, you see Captain America, you know, down and out, right, facing Thanos' army. Okay, so he's, you know, he's pretty much, you know, prepared to die for the universe, right? And then suddenly, you know, the Birdman came. And then what? Black Panther appeared. And then you have Wakanda forever! You know, that's where the Wakanda army, you know, comes in, right? And then they have a huge, you know, battle, and of course the good guy wins. So same thing for this particular hammer pattern. Similar story is that, you know, you can see that the buyers initially at the start, they were kind of like overwhelmed by the sellers before they took charge and then pushed the price up higher and closed near the highs of the day. So this is what the hammer pattern means. So it tells you that for now, right, temporarily the buyers are in control. And what most traders do is they kind of like take this out of context, right? And they think that whenever you spot a hammer, the market is going to reverse and it'll blast off to space, to Pluto, right, and go up higher forever. And that's not quite the case, right? So if you look at this chart over here, many traders will look at this chart and see, oh man, Rainer, it's a hammer, Wakanda forever, and then they think the market is going to reverse up higher, right? But that's not quite the case, because if you look at this, right, from a price action standpoint, pay attention. This is the trend. You can see that trend, right, has been heading down lower over the last few months, right? This is a daily time frame, right, since in December 2021. Now it's like, I think, July 2022. This market is consistently making lower highs and lower lows. And then what happened? On this chart, you see this one particular candle, this green candle that looks like a hammer, right? And you think that this candle over here is going to reverse this entire move up higher. So again, right, do manage your expectations. A hammer is not going to do wonders. Yes, it tells you that the buyers are temporarily in control, but what's likely to happen when you see such a price pattern, a candlestick pattern on the chart, is that maybe the market could go up for a while before the trend continues to, the trend resumes itself and the downtrend continues down lower. So bear this in mind, right? A candlestick pattern, right? The market is not going to reverse entirely just based on one candlestick pattern. You need much more than that, right? And later on, I'll share with you how you can actually utilize candlestick patterns, right, to help you, you know, better time your entries, right? More on that later. Moving on, mistake number 3. Your stop loss is at the wrong level. So how many times have you heard that, you know, man, you should place your stop loss below the swing low, you should place it below support? Well, guess what? That's not really a good idea. Why is that, right? Let me show you why. So, for example, if you look at this chart over here, you can see that when traders, they, let's say, for example, they look, oh man, Rainer, market is bouncing up higher. Let me go long and then set my stop loss below support at this red line over here. After all, that's what the gurus are teaching, right? Set your stop loss below support. Just set it above resistance. So here's the thing, right? When enough traders, you know, set their stop loss just below support or, you know, above resistance, right? It kind of like, you know, incentivizes the market to go to those levels to hit your stop loss, right? And then reverse back into your initial intended direction. So for example, what you'll do is this, right? There you go. You can see how the market, right, after you go long, it reverses down lower, hit your stop loss, which is placed just below this low, and then continue up higher, right? And then eventually reaching your target, right? So you can see that, you know, if you were to always, you know, set your stop loss just below the lows, just above the highs, right? This is something that you will likely experience, you know, pretty regularly. So now the question is, how should you set a proper stop loss? Well, here's how. Okay, follow along with me, right? So let's say, for example, you're looking at this chart, you notice the price, you know, is at, let's say, for example, at this area of support, and then you have this nice green candle over here that you want to, you know, go long, right, to buy because maybe you think the market will continue up higher. So as you know, right, you don't want to set your stop loss, right, for example, just below this low over here because you might get stopped at. So now the question is, you know, where do you set your stop loss? Ideally, you want to set it a distance away from this swing low. So ideally, a distance, you know, away could be somewhere about here. So again, this can be a bit subjective because some traders might think, you know, which part of, you know, here should you put? Is it over here, here, or maybe even here? So one objective technique to share with you is that you can use the average true range indicator, which simply, right, tells you what is the volatility of the market, and take that into account, right, when placing your stop loss. So just go to indicator over here, search for ATR, click on this, right, and this tab will appear. I usually like to go with a 20 period ATR because there's like 20 trading days in a month. I go with SMA to keep things simple. And if you look at the ATR value right now, it's telling you that the value is 5.4 over here. So this tells you that on average over the last 20 trading days, right, this market, right, which is Chesapeake Energy, this stock, right, moves an average of $5.40, right, over the last 20 days. So let's say you want to go long on the next candle open, right? How do you set your stop loss? So let's say, for example, this swing low, let's say, for example, find out what's the level. This swing low right now is currently, the low is $75.02. I mean, sorry, the swing low now is, yeah, $75.02, right? So this price at this low is now $75.02. And to make my life easier, I'll just make it $75. Okay, so let's say this low here is $75. I minus 1 ATR, and 1 ATR, as you know, the value now is $5.40. So I minus $5.40. This will give me, if my math right is fast enough, is $69.60, I believe. Yeah, $69.60. So this is where I will set my stop loss. So if I were to, you know, pull out a line on the chart, it looks something like this. Is okay, let's say over here, I'll just change this to red, right, to signify stop loss at the particular level at $69.60. Okay, so as you can see over here, this level is my stop loss. And now as you can see, I'm giving this trade more room to breathe. So this way, if the market does hit down lower and take out these lows, I'm still not stopped out. I still have a chance for this market to, you know, reverse up higher in my intended direction, because now I have, you know, given this trade more room to breathe. So let's see what happens now. What happens next, right? So you can see this market, next candle goes up, starts to, you know, show signs of indecision, hits down lower, and then, you know, traders who set their stop loss just below this low, as you can see over here, just below this low, they would have gotten stopped out, and they will, you know, curse and swear, you know, I hate you, Mr. Market, man, this entire thing, it's a fraud, it's a scam, blah blah blah. Then whereas, you know, smarter traders like you will be laughing on the sidelines, right, and not getting stopped out. Yeah. So after which, I think I cherry picked this chart, and I believe it just pretty much, you know, goes up higher, which is something that you probably are very familiar with already. How the market always seems to know where your stop loss is, right? Hunts your stop loss, eat it for breakfast, lunch, and dinner, and then moves finally in your intended direction while you're on the sidelines. Yeah. And by the way, if you're enjoying this trading so far, smash the thumbs up button. If not, then hit subscribe. Okay, so moving on, let's do a quick recap to what we have learned so far. Number one, the market doesn't care about your target, your risk to reward ratio, or what you have for breakfast, lunch, or dinner. Right? The market pretty much go where it wants to go based on, you know, buying and selling pressure in the markets. So this brings me to my next point. Your target profit should be at a level before opposing pressure steps in. Don't make the market work so hard to give you profits, because more often than not, it won't care what you want and pretty much will go against you. So for example, let's say you are in a long trade and you want to know where is a reasonable level to take profit. Usually that will be before resistance, before the swing high on your charts. And don't worry if you are not sure about this. Later on, I'll share with you a ton of examples, right? Because I'll share with you a very simple price action strategy that you can use to profit in bull and bear markets. All that later on with the examples, so things will be clearer then. Next one, a candlestick pattern is unlikely to reverse an existing trend. Yes, as you've seen, right, a hammer candlestick pattern, it is bullish, but it is not likely to reverse an existing downtrend, let's say, that has been going on for months or even years. So manage your expectation. Candlestick patterns, they are not magic, holy grail or whatsoever to help you, you know, buy low and sell high to predict, you know, market turning points with precision, right? Rather, take things into context, right? The trend, right, is if it's in place, right, over the last, let's say, 4 or 5 months, one candlestick pattern on that one daily candle isn't going to reverse that entire trend. And finally, right, your stop loss should be at a distance, right, away from price structure, so you don't get stopped up prematurely, so you can avoid stop hunting. Cool. So having learned all this in mind, right, we can now, you know, take these concepts and mistakes, right, to avoid, right, and actually develop a very simple price action trading strategy that allows you to profit in bull and bear markets, which is what I'm going to cover right now. Okay, now let's get started with the first part of this strategy, which is what I call market structure. So market structure is a very simple concept, right? You simply want to ask yourself, what is the current market condition? So you know whether to be a buyer, to be a seller, or to maybe even stay out of the market. So market structure can fall into one of 3 categories. Number one is what we call an uptrend. So if the market is in an uptrend that looks something like this, right? Higher highs and higher lows, goes up, pulls back, goes up, pulls back, goes up, pulls back. So if you see the market structure that looks something like this, what we call an uptrend, this type of price action, you only want to look for buying opportunities. Don't try to short the market. Only look for buying opportunities, meaning you're trying to, you know, buy in this type of market condition, right? To buy and then to sell at a higher price. Next one is what we call a downtrend. And in a market condition, which is in a downtrend that looks like this, right? A series of what we call a lower high, and a lower low, and a lower low. We only look for selling opportunities, right, in this market condition, because the market is in a downtrend. So we only look for selling opportunities to sell in this type of market condition. In this market condition, we don't look to buy at all. We only look to sell. And finally, right, last one is what I call a range market. And this one is a bit special because usually when the market is in a range, right, most traders will think, you know, you can either look to buy low and sell high. But for me, I like to take things a step further. I like to reference the higher time frame and see what the higher time frame is doing. If the higher time frame is in, let's say, an uptrend, Then in a range market, I only look for buying opportunities to put the odds in my favor. Later, I'll share with you some examples so you can see what I mean. Okay, so this pretty much sums up for market structure, and we'll look at examples later on. Second part of this strategy is to understand the area of value. This pretty much asks yourself, where do you enter a trade? So the market is in an uptrend, but where exactly do you buy? So this is where you can use the concept of support and resistance to help you with it. So support is essentially, right, an area on your chart where buying pressure might step in. So support looks something like this. Price goes up, comes down, goes up, comes down, goes up. Right now you can draw this area on your chart, right? And you know that if the price were to come back down for a third time, right, this is where buyers could come in and push the price up higher. So we call this an area of support. Likewise, the inverse is what we call resistance. So let's say I draw, again, price goes up, comes down, goes up, comes down, goes back up. This is what we call an area of resistance, because let's say you have, the first time it came down lower, second time came down lower. Now it's going back up resistance for a third time. There's a possibility that the price now could hit down lower once again. So this box over here, this area is what we call an area of resistance, where selling pressure might step in. The keyword here is might, not guarantee, might. Okay, so this area of value, which tells you, where on a chart, right, could you look for buying and selling opportunities. So now that you've spotted your area of value, the next question is, when exactly do you enter a trade? So this is where we use entry trigger. This could be concepts like hammer. Remember the hammer I talked to you about earlier? Wakanda forever? Yeah. So hammer, I'm not going to talk about hammer since, we spoke about that pretty extensive earlier. The opposite of a hammer is what we call a shooting star. So this is actually the inverse of a hammer. A shooting star simply tells you that, the market opened at this price point, then it went up to these highs, okay, for the day, right? Assuming this is a daily candle on a daily time frame. Then after which, right, the price goes up higher and higher to these highs, and then the buyers thought, oh, right, man, we are winning the game, we are winning the war. And then the sellers say, that's as far as you're gonna go, my friend. And then they push the price down lower, closing near the lows of this day over here, right? So this is what a shooting star pattern means. So you can see that initially at the start of the day, the buyers were in control, pushing the price near the highs of the day, only to get overwhelmed by the sellers, right, and close near the lows of the day. So this kind of like, right, you didn't study for your exam, right? And then when the result come out, you realize, man, you got an A, you're over the moon. Wow, I got an A without studying for exam, amazing. And then you realize A is for absent. Yeah, so your whole world come crashing down. Same for this shooting star pattern, yeah? And of course, right, this is pretty much the low of the day, right? As I've, covered earlier as well. Now, this is entry trigger. So the entry trigger here is useful to help you time your entry. So when you, let's say, for example, you see a hammer, right? Market is in an uptrend coming towards an area of value. You can use a candlestick pattern like the hammer to time your entry to tell you when exactly to enter a trade. Don't worry. I'll share with you a few chart examples so you can see what I mean. But for now, understand that an entry trigger is a very useful technique to tell you, when exactly to enter a trade. Because once you see, for example, you are bullish and you see the market conditions, fit your trading rules, and a hammer is formed, this tells you that the buyers are temporarily in control and you could possibly enter on the next candle open when the market opens the next day. Yeah, so that's how an entry trigger works. And finally, we have to talk about exits, because the market, right, doesn't mean every time you put on a trade, it's going to move in your favor. There are times where it will move against you, so you must know, right, where to exit if you are wrong. And if, let's say, there are times where you're right, where do you exit when you're right? So I believe we have talked about stop loss earlier, right? Setting a stop loss, right? Setting your stop loss distance 1 ATR below the price structure. Of course, you don't have to use 1 ATR. If you want to be more conservative, you can go with 0.5 ATR. If you want to be more if you want to be more aggressive to have a tighter stop loss, you can go with 0.5 ATR instead of the 1 ATR. So if you know that 1 ATR, for example, the value, let's say, is $1, then 0.5 ATR is simply half of $1, which is 50 cents. And of course, if you want to be more conservative to have a wider stop loss, you can go with 1.5 ATR or even 2 ATR if you prefer. Now, what about target profit? So target profit, I believe we covered that as well earlier, but just to share with you quickly. So let's say, for example, you are, let's say, in a short trade. Let's say price goes up, comes down, goes up. You sell at this area of resistance and the market is heading down lower. Where do you set your target profit? Do you set it here, A, B, or do you set it here at C? What's your answer? I will give you 5 seconds, right? 1, 2, 3, 4, 5. Okay. Answer is C, right? Because remember, you want to set your target before opposing pressure steps in. So if you say C, well done. So now we can look at some examples, right? Or rather, before we look at some examples, let me just kind of consolidate all the 4 concepts that I've just shared with you into a tradable trading strategy. So trading rules for long is this. Number 1, if the market is in an uptrend, then you look for the price to retest support. Okay, I believe that's your word called then look for the price to retest support, but it's missing. Never mind. If the price retests support, right, then look for an entry trigger to go along. This could be something as simple like a hammer candlestick pattern, which we've covered earlier. Number 3, if the trade is triggered, set your stop loss 1 ATR below support or the swing low. And finally, number 4, if the price moves in your favor, you can take profit before the nearest resistance or swing high. Okay, so for short, it's just the inverse. I'll just go quickly. You can see if the market is at a downtrend, look for the price to retest resistance. If it retests resistance, look for an entry trigger to go short. Could be something like a shooting star pattern, as you've learned earlier. If the trade is triggered, set your stop loss 1 ATR above resistance or the swing high. So remember, the ATR, this one over here, is flexible. If you want to have a tighter stop loss, it can be 0.5 ATR. You want a wider stop loss, it can be a 1.5 or 2 ATR above resistance. And finally, if the price moves in your favor, take profit before the nearest, this is wrong, this should be support, naughty, Rainer, should be take profit before the nearest support or swing low. So let me just, yeah, you get what I mean, yeah? So moving on, let's have a look at some examples. Okay, example number 1, right? So let me ask you, right, what is the current market structure on this chart? So ask yourself, right, what is the current market structure? Is it in an uptrend? Is it in a downtrend? Or is it in a range? Okay, so the answer is downtrend. So as you know, right, if the market is in a downtrend, then we want to look for selling opportunities only, right? We want to avoid buying. So where can we look for selling opportunities? You can look at the swing high or at an area of resistance. So in this case, you can see that this market has come towards this area of resistance over here. Great. You can see how the price is actually right now just breaking out above resistance, right? But bear in mind, resistance is an area on your chart, so sometimes the price could overshoot resistance, right? And then, head down lower, thereby, resulting in a false breakout. That happens pretty often as well. So once you know the market is at an area of resistance, then we are looking for an entry trigger to go long. So what entry trigger have you learned? You've learned things like, a shooting star pattern. Of course, that's not the only one. You have also things like bearish engulfing pattern, right? Which in this case, let me just have a look. Let's see what happens. Let me just draw a better, I think we can just skip this. Okay, let's see what happens next, right? You can see over here, this is what we call a bearish engulfing pattern over here, where the candle, this candle, has the same meaning as a shooting star pattern. It is bearish, and there's short-term weakness in the market, and tells you that the sellers are temporarily in control, as the market has actually closed up near the highs. Next day, go up near these highs and got reversed by the sellers, closing near the lows of the day over here. So now you have a valid entry trigger to go short. So 2 questions to answer. Where do you exit if you're wrong? And where do you exit if you're right? So let's talk about stop loss first, right? As you know, let's go with a typical 1 ATR stop loss, because the last thing that we want, right, is for the market to, let's say we enter over here, then go up higher, hit our stop loss, and then hit down lower again, because that could happen. So let's set our stop loss, right, a distance above this swing high over here. So I'm going to pull out the ATR indicator as I shared with you earlier. As you can see over here, the ATR indicator right now is on the chart, and it says that right now the ATR value is about 68 pips. So what I'm going to do is just to find out what's the high of this current entry trigger candle. So the high over here, I'm just going to have a look, right? It's right now it's currently at 8512, 0.8512. I'm looking at this number over here, okay? So look at it, it's currently at 0.8512. So I'm just going to find 0.8512 plus 68 pips. That will give me 8580. Okay, so my stop loss will be 0.8580. Okay, so I'm just going to change this to 0.8580. That is my stop loss. All right, so over here, basically, from here all the way up to here is 1 ATR, right? 1 ATR as shown over here, 1 ATR. Okay, now the next question is, where do we enter a trade? Well, very simple. You can just simply enter the trade on the next candle open. So for example, let's say the next candle open looks something like this. Okay, so this is where you enter the trade, the next candle open, which is over here. You're in this short trade already. Of course, some of you who wants to be a little bit more of a cheapskate like me, I usually like to be a cheapskate. You can place a sell limit order a few pips, alright, above the previous day closing price, maybe somewhere here, to get in at a slightly better price. Anyway, moving on. Where do we set our target? So again, right, we don't want to set our target, let's say, for example, here, just for the sake of having a minimum of a 1 to 2, 1 to 3 risk-reward ratio, because we're not respecting the market. So if we look at the price structure of the market, the nearest price structure that we can see is this one over here, and then this one over here. So let's say, to be conservative, we look for a target at this level. Let's just change this. I'm just going to change this to, let's say, green color. Okay, let's change this to green, right, to signify our entry price, okay? And then over here to blue, right, to signify our target profit, where we are looking to take profit over here. Change this to blue. Okay, so let's see what happens. Okay, so I'm just going to remove the ATR indicator, not needed. So next day this happens, right? Market hit down lower in our favor. Woohoo, right? Feeling good about this. All right, still almost there, right? Almost booking a profit, and then quite close, but not quite enough. Come on, come on, come on. Almost there. And yep, you probably would have exited this trade for a winning trade, as this candle, right, the lows have touched your target and you would have, book a profit on this particular trade. So yeah, this is just one example. Next, let's have a look at another. Okay, example number 2, right? This is the chart of Vermilion Energy. So remember our trading rules, right? What is the market structure? Uptrend, downtrend, or range? Well, in this case, if you ask me, it's in an uptrend. So in an uptrend, we look to buy only. So next thing we look for is for the market to come towards an area of value. In this case, it came towards this area of support, right? You can see over here, it tested like kind of a once, twice, and now we're back here for a third time. Now we're at support. When do we get long? We look for a valid entry trigger to go long in the form of a candlestick pattern. Now we got a bullish hammer. So great, right? So now we are looking set, right, to enter a trade on the next day open. So let's find out what happens. What happens next? So next day market opens over here. Great, we are now in a long trade. We enter at the opening price, let's say somewhere here. Okay, just change this to green to signify the entry price. Now what about stop loss, right? As you've learned by now, your stop loss is usually a distance below support, right? So usually you can go with 1 ATR. So I'm not going to calculate it, right? So I'll just aga, or rather give it a rough estimate to be somewhere about here. Okay, so this is the red line. This is where your stop loss is. Okay, somewhere about here, okay? And for target, as you know, you want to set your target just before resistance. So let's get your target somewhere about here, and let's change this to blue. So now your trade is set, right? So let's find out, right, how this trade, unfolds itself. Next day the market goes up higher. You're feeling pretty okay, right? Since it's pretty near your entry price, not too happy, not too sad. Then the market starts moving a little further in your favor. Now you're feeling a little hopeful. Yeah, right? Another winning trade possibly on the cards. Let's do this. Man, what's up with this bearish candle? It happens, right? But, let's follow the plan. Rainer says, follow the plan. I can do this. I'll follow my plans no matter what, so I can become a consistently profitable trader. I can do it. Then, market shows signs of a slight higher close, right? Not too bad, not too sad, right? Let's do this. Let's go. Damn, right? That's what I'm talking about, baby. Let's do this, right? Market says reverse up higher to the moon. Alright, we're almost there. We're more than halfway there, my friend. I'm gonna, I can smell the money already. Ka-ching! Then the market has this bearish engulfing pattern. Man, is the market gonna hit my stop loss? Man, should I book profits now? Gosh, trader says follow the plan. Okay, let's follow the plan. Next day, market starts to stall. Boom! Ouch! What the beep is going on? Come on, man. Don't hit my stop loss. I just left my McDonald's job. I don't want to go back to, have lunch for fries. I don't have, fries for lunch again. Come on, Come on. Please, don't hit my stop loss. Market starts to stall. At that point, okay. The good thing is I didn't set my stop loss below this low. If not, I'll be one of those idiots who got stopped out on this candle over here. That's a slight consolation. However, the downside is that the market still has not reversed back in my favor. Come on, you can do this. Come on. Not looking too pretty. I can feel the pain. This trade is probably gonna be a loser. Man, this sucks. Trading sucks. But still, Rainer says follow the plan. Okay, I'll follow the plan. After all, what's there to lose, right? It's almost halfway to my stop loss already. Come on. Okay, a glimmer of hope. A new hope. Whew. How far can this go? Let's see. Alright, we're back in business, baby. That's what Rainer talking about. Follow the plan. Yeah. Slight move in my favor. Better than nothing. Let's do this. Come on. Oh no, God, not again, Lord. Please don't put me through that torment. Come on. Oh man, okay, not too bad. Oh dear Lord, please don't hit my stop loss. I promise you I'll be a good boy. I won't watch Pornhub for 6 months. Please, Lord, please go in my favor. Please. Alright, that's what I'm talking about. Yes, let's go. Oh, almost there. Yep, baby, that's what I'm talking about. Right. We're almost there. 3/4 of our way through. Let's go. Gosh, I hate this candlestick pattern. Will the market hit my stop loss, right? Should I take profits? Rainer says follow the plan. We're almost there. Let's see what happens next. Boom! Hooray! TP, right? We exited with a profit. Life is good, right? I am the champ. Who's your daddy? Come, let's log into Pornhub right now. Let's go. Okay, so example number 3. So the previous example, right, I kind of exaggerate things a little bit, but really is to help you understand that in trading, right, doesn't mean that the market always has to move in your favor quickly. Sometimes you can mess around with your feelings, go up, down, play your heart, play your mind, make you think man, this sucks, it's the end of the world. But as long as you have a fixed plan in place, right, guess what? The worst that can happen is your stop loss get hit, right? The upside is that the market is going to reach your target. It's pretty much one of two things is going to happen. So this is what happens when you have a fixed trading plan, right? It kind of will reduce the emotions that you are going through, right? But there will likely still be emotions, right? As what I've shared earlier. So moving on, right? Next one over here. Have a look at this chart, right? You can see what is the market structure? Market structure is in an uptrend. So we look for buying opportunities at this area of support. Then we have this bullish entry trigger in the form of a hammer, right? So we can look to enter on the next candle open. So let's do just that. So let's say next day what happens is this, okay? So market has, we go long on next candle open. Let's say put it in green. I'll move a bit faster since you already know what I'm talking about. Stop loss, right, is again a 1 ATR below the low of the hammer. So probably somewhere here is your stop loss. And your target again is before resistance. So let's say somewhere here is your target. Let's put this in blue. Now let's see how this trade plays out, right? So next candle, market, right, open and then move quickly against you. Ouch, that sucks. Next day it moves further against you. Ah, gosh, not again. Then slight hope, right? Yeah, market is back, you know, her rallying, right? Almost back to break even. We can do this. Yep, almost there. Or rather in the money already, all right. Market starts going up higher, right? And you're starting to feel comfortable. Hooray. Yep, slowly progressing, slowly but surely. Yeah, baby, we're halfway there. All right, let's do this. Then the market starts stalling, right? So this is kind of like a bearish candle. Man, should I, you know, shift my stop loss to break even? Man, will I get stopped out? So all these thoughts will run in your mind, right? Next thing, market shows you a shooting star pattern. Ah, yes, this is, I mean, this is not a good sign. But still, Rainer says follow the plan. Okay, I'll follow the plan. Market starts reversing. Man, should have took profit. Man, I'll follow the plan. Market shows some slight hope, right? Green candle, then starts going down lower. Stall a little bit. Goes down low. Ah, gosh, you know, almost to my stop loss. This could be a losing trade. Well, my stop loss is in place. What's the worst that can happen? I'll just take a small loss on my account. Ah, stopped out. So in this case, right, the candle, as you can see, pretty much hit your stop loss and you would have gotten stopped out. And if you think, Rainer, no, it didn't hit your stop loss, not yet stopped out. Okay, one last candle. Now you happy now? Yeah, you got stopped out on this trade. So the reason I'm sharing this with you is in trading, right? It doesn't matter, you know, whether you have so-called the best trading strategy or whatnot, because whether all the stars or the moon has aligned, your trade can still turn out to be a loser. I've been trading for more than 10 years, and the next trade that I put on every time, I still do not know whether it's going to be a winner or loser. So this is why we have a stop loss in place to protect your downside. So in this case, right, it's a losing trade. I just want to manage your expectations that the strategy that I'm teaching you is not a holy grail, it's not a 100% winning rate. You will have losses, right? So manage your expectations, and let's move on to the third, or rather the fourth example. Okay, in this example, I want to share with you a little bit of advanced price action trading techniques. So you can see that this chart is the chart of the dollar against the Chinese yuan. It's on the 4-hour time frame, and you can see that right now this market, what's the market structure? You can see that it's pretty much in the range, right, between this area of support and resistance. And if you recall earlier, when I say that, you know, when the market is in a range, I like to reference the higher time frame, right, to decide what direction to trade. So if you look at this chart on the higher time frame, let's go to the daily. You'll notice that, hey, this market is actually in an uptrend. Okay, so ignore this black line over here. Not sure what it's doing, trying to be funny, but yeah, ignore that black line. So you can see that this market is in an uptrend. So great. So this means that we want to look for buying opportunities, right, since we are trading in the direction of the long-term trend, which is up. So on the 4-hour time frame, we have a valid entry trigger to go long, which is over here, right? This is an area of support. Market, right, had a false breakdown, it hits down lower and then quickly reverse and close back into support. So we can go long on the next candle open. So let's see what happens next. Next candle, market went against us, no worries. This is our entry price. Okay, so let me just change to green. Then our target, right, I'll talk about target later. First let's talk about our stop loss. Let's say somewhere here. Okay, our stop loss in this case will reference the 4-hour time frame to set our stop loss. So let's say somewhere here. Now, what about target? So if you ask me, right, I want to share with you one thing is that if you look at the higher time frame, right, you can see that this market is actually in an uptrend. So if you think about this, if you were to, let's say, set your target somewhere here or here, right, if the market does break out, won't you be leaving a lot of money on the table? Right? You feel me? So what you can do is this, right? So you can actually use multiple targets. So in this case, let's go back to the 4-hour time frame. Let's say our first target is over here, just before the nearest swing high. Let's say somewhere here. Okay, let's say just here. Okay, let's put this in blue color. Okay. And if the market reaches our first target, let's say it does, let's see what happens, right? I can tell you it goes up higher because I cherry picked this chart. Yeah, so let's say the market, I'll go quickly, right? Market, yep, you can see over here, reach our first target over here relatively quickly after some pain, but reach your first target. So what you can do is exit half your position. So let's say if you buy 1,000 units of dollar against the Chinese yuan, you can sell 500 away, right? Sell it. and then you have another remaining 500 units on hand. You can have the remaining 500 units, right, to ride this upward trend, because as you've seen earlier on the daily time frame, this market is in an uptrend. What if this uptrend continues up higher? There's a lot of potential profits, right, that you will leave on the table if you exit your entire position. So if you notice this, what you can do is you can actually have a trailing stop loss on the remaining half of your position. Now, it's not within the scope of this video to talk, all the different techniques to trail your stop loss, but what you can do is, let's say, for example, use the 50 period moving average to trail your stop loss, right, which is actually this blue line over here, right? If you want to know where to search for it, just go to indicators, search for moving average, right? Click on this one, right? And in this case, I went with the 50 period moving average as shown over here. So what you can do next, right, is that if the market closes, let's say it goes down lower and closes below this blue line, the market is now closed, the candle is closed below the blue line, you would then exit your trade. But if it doesn't do that, right, you can potentially hold this trade longer and ride the move up higher. So let's see what happens next. So in this case, you can see that I'm just going to play quickly, right? This market pretty much has, went very nicely in your favor, and right now you can see that your remaining half of the position, right, would still be holding that trade, right, as it has not closed below the 50 period moving average over here. So this is an advanced technique that you can use, right? If you know that, hey, the higher time frame is trending pretty strongly, you can look to take partial profits at before the nearest target and have the remaining half using a trailing stop loss, right, to see how much further of the trend, right, that you can ride to kind of maximize your profits. Okay, example 5 over here, right? So you can see that over here, this market is pretty much in a range. And as you've learned earlier, if the market is in a range, I like to reference the higher time frame to see what the market is doing. So in this case, right, the market is kind of in the range between these highs and these lows, right? Between these highs and these lows over here. So let's see what the higher time frame is doing. So this is the daily time frame. I go up to the weekly and I see this. The weekly is also kind of in a range, right? Because you can see this market not really moving anywhere over the last few months, right? So it's still in the range. So in these instances, right, I wouldn't use the previous technique that I've shared with you, which is, to trail the remaining half of your position, because, the market isn't really trending at this point in time. But still, let's say if you want to take a trade, right, what you could do is this. On the daily time frame, okay, I just go quickly, right? You can see that we have a valid entry trigger where the price, right, you can see over here, let's read the price section of this market. This is the area of support over here. Okay, and this market, right, tried to break down support multiple times. First attempts on this candle here, it tried to hit down lower, couldn't. Then the next candle, it tried to break down below support on this candle over here, couldn't. Next candle, it rallied. Then it tried, right, on this 2 days later, maybe 3 days, it tried to break down lower once again, still couldn't break lower. Instead, it just got a long-legged doji looking pattern. I think this is what we call a dragonfly doji, yeah? And basically telling me that, hey, the buyers are stepping in to push the price higher, and now we're back up, at support. So you can see that the market tried to break down support multiple times but failed, right? So this to me is a sign of strength, and you can look to enter on the next candle open. So let's say next candle we have a market open like this, right? You can look to enter on the next candle open somewhere about here. Okay, I'll just put this in green. I'll not talk about I'll just talk about stop loss, right, for the sake of completion, right? So stop loss, as usual, a distance below the low, let's say somewhere here. Okay, I'll put this in red. Now, what about target? So if you look at your target, right, you actually have multiple levels to consider, because the first target could jolly well be here. This is where previous support, which could become resistance, fair enough. Then you look at slightly up higher, this could be even a juicier target, because if the market reached to this second target, you could even, make more money, right? So what do? You have two options. You're spoiled for choice. If you, bang your trade, right, all on this target, what if the market goes up to the second one and, you left something on the table? But what if you bang the trade all on this second target, right, and the market pretty much goes up and then reverse down lower and then you get stopped out? So what do you do? Well, option that you can consider is this, right? So a popular technique is that what you can do is you actually have multiple targets. So this over here is target 1. Let's call it TP1. So if the trade reaches target 1, you exit half your position. So again, half position, you exit. I just put it across your exit. So you have the remaining half on hand, right? So you can hold the remaining half of your position to see if it reaches target 2 over here. Okay? So you have two target, TP1, target profit 1, and target profit 2. So this technique is useful if, the higher time frame doesn't really give you a clear direction and it's still in the range market. You can actually have, two targets for this particular trade, right? And see, and just simply take what the market gives you. All right. Now, if you have enjoyed this training so far, then you will love, right, this book called Price Action Trading Secrets. It's a 142 page, right? It's a full color trading book where you'll discover, right, price action trading strategies and techniques, right, to profit in bull and bear markets. You can apply it to the stock markets, the forex markets, the cryptocurrency markets, etc. We dive into things like, candlestick patterns, how to draw support resistance, proper risk management so you don't blow up your account, breakout trading strategies, and much, much more. And here's the thing, right, you are protected by my 60-day, no questions asked, money back guarantee. So when you get a copy of this book, you find that you don't get value, you don't love it, then just email us, right? Let us know and we'll happily refund you in full, no questions asked, and you can still keep a copy of the book. Sounds good? Then click the link somewhere below this video, grab a copy of this book, and I will talk to you soon.